Welcome to the MUFG Global Markets Asia podcast. I'm Lloyd Chan, Senior Currency Analyst with the MUFG Global Markets Asia Research Team. Today is 11 June 2024. The following podcast is for informational purposes only. It is intended for professional investors and eligible counterparties and not for retail clients. Any content should not be regarded as an offer to conduct investment businesses or investment recommendations. For this episode, we would like to discuss two things. One, where we think the Indonesian Rupiah will be headed in the short term, after it has depreciated by more than 5% versus the US dollar year to date, and gone through a roller coaster ride in May, whereby the Rupiah strengthened against the US dollar in the first half of May, only to give back those gains in the second half of that month. And two, we would also like to take this opportunity to share about how we think Indonesia's plan to build an end-to-end electric vehicle supply chain can move the needle on the long-term outlook of the Rupiah. In the short term, we look for the Rupiah to consolidate around 16,000 to 16,200 against the US dollar in the next 3 months, before gaining modestly against the US dollar in late 2024. There are several reasons for this. First, the Rupiah weakness in the second half of May was partly due to dividend payout by Indonesian companies. We believe this outflow pressure is seasonal. The amount of dividend payout will likely moderate in the coming months, reducing outflow pressures. Second, we keep our base case for US interest rates to trend lower in the next 6 to 12 months and the US dollar to weaken, as we anticipate US inflation will make further progress while the US economy will show signs of weakness ahead. Third, Bank Indonesia has the FX firepower to guard the Rupiah against external shocks and high for longer US interest rates. More importantly, Bank Indonesia's willingness to react swiftly to support the Rupiah using a range of instruments should help the currency. We have seen Bank Indonesia raise the policy rate by 25 basis points to 6.25% in April to support the Rupiah. Other instruments include directly intervening in the FX market and issuing its own Rupiah securities, also known as SRBI, at an attractive yield of more than 7% to retain capital and attract inflows. The attractive yield on the SRBI has gained a lot of traction with foreign investors, which now hold about 28% of total SRBI outstanding, compared to about 7% when the SRBI was first launched in September 2023. Lastly, we assume global financial uncertainty will ease, with better clarity of the timing of US rate cuts in the months ahead and no significant escalation of geopolitical tensions in the Middle East. However, there's a risk that the Rupiah could still fall to its COVID period low of around 16,600 against the US dollar. Geopolitical risks in the Middle East could suddenly flare up again, and the strong non-farm payroll numbers last Friday add to the probability of higher for longer US interest rates. It is clear that the Rupiah won't be immune to sudden bouts of global volatility. Beyond the short-term headwinds, we think there is scope for the Rupiah to stabilize, as the long-term appeal of the currency has improved. A key driver is the nickel export ban implemented by President Jokowi in January 2020, along with his associated plan to construct an end-to-end electric vehicle supply chain in the country. Indonesia is blessed with nickel and is the world's largest nickel producer, accounting for half the world's nickel output. And nickel is a critical ingredient in the nickel-based EV battery production. So, by banning the export of raw nickel since 2020, Indonesia has made itself an indispensable partner in the global transition towards electric vehicles. The nickel export ban has done two great things for the Indonesian economy. One, the ban has forced global manufacturers to invest and set up nickel refining facilities in Indonesia, partly driving the increase in foreign direct investment, or FDI. And two, support trade by exporting higher value refined nickel and nickel intermediates rather than just exporting raw nickel. So, To put some numbers on these benefits, our analysis shows that since the nickel export ban in January 2020, annual realized FDI inflows increased by about $22 billion in 2023. FDI into the mining and basic metal sector contributed to nearly half of that increase. Prior to this, annual FDI flows were stagnant during President Jokowi's first 5-year term in office from 2014 to 2019. There has also been a notable rise in Chinese investment in the basic metal sector, particularly nickel smelting, following the nickel export ban. China lacks nickel reserves, yet it is a major downstream consumer of nickel for producing stainless steel and lithium-ion batteries for electric vehicles. So, the electric vehicle sector has led to closer China-Indonesian economic ties. The basic metal sector also contributed about 40% of the positive trade balance in 2023. Prior to the export ban, iron and steel trade balance was in deficits. With the global electric vehicle sales expected to grow at a compounded annual growth rate of 27% to reach more than 40 million units by 2030, there will be increased demand for EV batteries and nickel. EV battery will be a crucial growth driver of nickel demand in the years ahead. Currently, nickel has mainly been used to produce stainless steel, with only 15% going to EV battery manufacturing. But by 2040, the share of nickel used for EV battery production will rise to about 40%. These positive contributions will likely only get bigger, which could strengthen Indonesia's external resilience and foster rupiah stability. Moreover, the nickel downstreaming policy is likely to continue under incoming President Prabowo, as he has pledged to continue the major economic policies of outgoing President Jokowi. So, Indonesia has a grip on the upstream segment of the electric vehicle supply chain, driven by its natural advantage in nickel reserves, which is accompanied by the nickel export ban. However, a foray into the midstream, such as EV battery production, and downstream sectors, such as EV production, currently dominated by China, will be equally crucial. Encouragingly, we have seen policy positives from the government, which will help boost electric vehicle-related investment. For example, 4 state-owned enterprises have formed the Indonesia Battery Corporation in 2021 to support the development of EV battery cells. EV adoption has also gathered pace in recent years, jumping to 17,000 units from less than 100 in 2019. It has benefited from the government cutting the value-added tax to 1% from 11% for battery-based electric vehicles, with local content of more than 40% in 2023, with the remaining 10% value-added tax being absorbed by the government. However, there's still quite a lot of catch-up to do for Indonesia in the midstream and downstream EV segments. Currently, China dominates the global EV supply chain in areas of EV battery manufacturing and the global EV market share. And EV penetration is still relatively low in Indonesia, about 1.7% versus about 18% in Singapore, for instance. This constrains Indonesia's ability to attract more EV makers to set up production facilities in the country. The top 3 challenges in faster EV adoption include difficulty in finding public EV charging stations, EV pricing, and limited travelling range. Even with a 10% discount for purchasing an EV, a mid-class EV is still priced above 300 million rupiah in Indonesia, which is unaffordable for many. Indonesia still has some way to go to establish an end-to-end EV supply chain, but the country dares to dream and is making concerted efforts to achieve its goal, which might be a game changer for the rupiah over the long term. Thank you for listening to the MUFG Global Markets Asia podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you subscribe to your podcast. Contact your MUFG sales representative for more information. Check back again for more insights from the Global Markets Research Team.